Welcome, everyone, to another discussion between my dear friends and also advisors to Matterhorn Asset Management. And not only that, but they're also two of the top experts in the world on the world economy and precious metals. So we're going to have a fun discussion, I'm sure. And if you don't recognize them, I'm sure you do. It's Grant Williams and, of course, Ronni Stoeferle. So welcome and nice to see you. I think we are all in different.
Good to see you, gents.
Yeah, Ronni, welcome.
Good to see you, Grant. Good to see you, Egon.
We're all in slightly different parts of the world, as always. And before we started, we talked about the football. When we talk about football, we Europeans, there is only one football, and Americans don't know what it is. But it's not soccer; it's football, proper football with a round ball. Anyway, and we were all watching the semi-final of the European Championships yesterday between England. And was there another team that lost? Yeah, Denmark. Of course, it was Denmark. And now we look forward to the final between Italy and England. At Wembley. So that'll be fantastic on Sunday. Anyway, you probably didn't come to listen to the European football. So let's talk about something more difficult. And we're glad at least that we have now football matches with an audience, with the public, people watching, because who would have thought, of the three of us certainly, that a year later we still have quarantine, we still have COVID, we still have another strain of COVID, the Delta strain, that is increasing in every country in Europe, basically. But it's interesting because I've spent time in three countries: Switzerland, England, and in the summer sometime in Sweden. And here I am in Sweden. This is the Baltic behind me here. And how they all treat it differently. I mean, the UK basically has been closed down for most of the time, quarantine and masks, and you were not allowed to meet more than a few people at the time, etc. Switzerland has been in between, while Sweden, of course, in England, the Prime Minister is on television every day talking about COVID. In Sweden, the Prime Minister never talks about COVID because it's the health officials that they don't even appear. They don't interfere on a daily basis. It's so wonderful. So here I I was in England before I came here, wearing masks, etc. Now, no mask, no restrictions, no quarantine, and there are not more cases here than anywhere else. What do you think, Ronald? What do you think is going to happen in a year's time? Do you dare to forecast now, or where are we going to be on the COVID problem?
Well, as far as I know the Greek alphabet, we're now at Delta, and there are still a couple of letters left. So I got no idea, Egon, honestly. I think that, having a look at Africa, having a look at how COVID is still spread around Asia and Latin America, I don't think that it's going to be over very soon. I can just tell you, from my point of view, traveling, and especially business traveling, which used to be fairly easy over the last couple of years, it's now it's really a disaster, and we're planning, going to Greece with the family. I'm doing some gold conferences in the US, and it feels like planning for a big expedition to the Antarctica, and it's really horrible, and I really hope that we'll get back to normal soon. But obviously, that affects our kind of business. The longer it takes, the more leeway there will be for central bankers to stay dovish, and for politicians to spend more money and to be more, to implement more fiscal stimulus. So, as we've seen today with the ECB press conference, ECB is now also moving to a symmetric inflation targeting policy. And of course, one of the main reasonings for them was the whole COVID crisis. So they're using every excuse they can to decrease the purchasing power of our money.
That's the problem I find. You know, I just had in my English bank accounts at Barclays, I had a telephone contact with them recently, and they took ages to reply. Even though I have a priority service, and then I said, why? And then of course the obvious answer is COVID. You know, they're all working from home anyway. These telephonists. They're not affected by COVID, but everyone blames COVID for everything now. Grant. Is this paradise lost or paradise regained, to use Milton's poem? Sure, you can say that for some for some professions, if you want, it's been paradise lost with the travel industry, leisure industry, etc. It's been disastrous. On the other hand, the area that we move in, the banking system, and for the high net worth individuals and the wealthy and big corporations, it's like paradise regained. So you know, it's a massive discrepancy between the haves and the have-nots here. What do you see?
Yeah, it is. You're right. I mean, unfortunately, we can break it down into as many different segments as we want in terms of how has it affected this group, that group. But I think it's inarguable that as a society, it's paradise lost. There's no doubt about that. You know, this idea of working from home, this idea of isolating people, quarantining people, keeping people apart, it cannot be good for society, unfortunately. And for that to happen at a time when society is already fragmented is perhaps the biggest tragedy of this. You know, because it was interesting this week or last week, Singapore announced that, you know, they're going to start living with COVID. You know, they've started talking about not reporting the numbers anymore. They realize that this is now endemic. It's going to be around. It's something we have to live with. The data that I've seen in terms of how the vaccinations have reduced deaths and hospital admissions suggests that we are going to be living with this thing for a while now. So the question becomes, how do we get back to normal? How do we get back to the world we knew pre-COVID? And sadly, I think that's quite some way away, whether it be travel restrictions on an international basis, or whether it be restrictions still in evidence inside countries themselves. I think we're a long way from normal. A lot of people have gotten used to this now, to your point, Egon. I think that's going to be problematic, but it's something we just have to deal with. Everybody has to get on with things the best way they can, and you know, we're incredibly adaptable as a species. Man, we've adapted to all kinds of things over the years, and we will adapt to this. It just sadly, I think, for guys like ourselves who think in this way, what this really means is a certain amount of further erosion of freedom, and that's a terrible tragedy.
But we don't really want to talk about political side here, but still, as I said, I can compare to then various countries. Now I compare Sweden to the UK, and Sweden here, the society has never been closed. Industries worked as normal, basically. GDP was hardly touched in the first year after this happened, because everything was working normally, and people were given the responsibility to decide for themselves if they want to meet other people or if they don't. I mean, and the UK is now talking about that, but every time the UK has talked about having less restrictions, they've gone back again. So you can't trust them. But nevertheless,
well, at the other end of the scale, look at Australia. Australia is completely closed to the outside world. They're talking about it being closed until 2022 already. They've had very little COVID there, and because of that, very few people have been getting vaccinated. So they have I think it's in the teens, the percentage of people who've had have had one shot. And every time there's an outbreak of a dozen cases, they put millions of people into lockdown for a week. So that that's the other end of the scale. And I obviously I'm in no way qualified to opine on this, but it seems to me that at some point one has to just become pragmatic about this and realize that we have to, as Singapore said, live with this. So what's the best way to live with it? And hopefully that's the phase we're going into now, where people are starting to think about, okay, well, we know it's a problem, but how do we minimize the damage it's doing to society?
Yeah. Well, we will learn to live with it, but at the same time, Ronnie, if you look at stimulus, is not going to end today, is it? And of course, COVID has been an incredibly convenient excuse for Federal Reserve and central banks and governments to inject unlimited funds into the economy. And we'll come on to that later. But of course, in my view, it all started with the repo actions and the panicking of the central banks back in September 2019, and COVID just exacerbated this, but the problem was already there. But Ronnie, how do you see this stimulus continuing, and how will that affect now the markets that we'll be talking about?
Well, I think that people still continue to focus way too much on the Federal Reserve. I think we should look much more closely on what governments and the White House are actually doing. And I think that Joe Biden will continue to push the envelope. And $1 trillion US dollars used to be a really big number, but we are getting used to it, and I think that's what my friend Kevin Muir wrote about really brilliantly. He said that Wall Street and Washington are operating in completely different time frames, and I think if you have a look at what Joe Biden does, he basically decided that the country needs to undergo a big transformation, and probably a transformation that we haven't seen in generations. We know that Joe Biden is probably going to be a one-term president, and he doesn't have too much time. So I think, as I've said, he will continue to push the envelope, and then of course this basically confirms our view that we already had before COVID, that we developed while listening to super boring speeches by central bankers, but they always said, well, we have basically done what we could after the GFC. Now it's a turn of politicians. Now it's a time of fiscal policy, and this is happening. And in short, austerity is out. Nobody cares about this frugal Swabian housewife anymore. Nobody cares about budget surpluses anymore. And I think this much higher importance of fiscal policy, and also this merging of monetary and fiscal policy is something that will continue for the next couple of years. And I have to say, I haven't read the whole release from the ECB today, but it's obvious that there is now new tasks for monetary policy, and I don't know if it's really the mandate of the ECB to fight climate change. But sometimes, if you listen to Fed governors and ECB representatives, you think it's somebody from Greenpeace or a social worker. And I don't want to judge that, but I think it's just interesting to see that they have now basically taken new responsibilities. And I would say, well, fighting climate change is another reason to become or to stay very, very dovish and to continue extreme monetary policy for the next years to come. So, to put it in a nutshell, for gold, this should provide a pretty good environment. Although everybody thought that the Fed is now becoming super hawkish after the FOMC statement in June, I don't think so. I think they are walking on thin ice, actually.
Yeah.
And therefore, sorry.
Now, yeah, let's get on to gold a little bit later. But my view of central banks is, of course, that they shouldn't exist because they're always behind the curve. I mean, if you look at interest rates, real interest rates, they always react after the event, not before the event. And basically, I think they achieve very little, except for making the peaks and the bottoms much greater than they would be, and therefore turning the world economy into a casino for gamblers, and then disasters for a lot of people once they turns, which it will do this time also. But so coming back to stimulus and inflation, deflation, Grant, you've talked to quite a lot of people in your podcasts and in your interviews and articles, and you have both sides. You have the Lacy Hunt side which is deflationary, and you have, I think, Luke Groman, who's very interesting and is more on the inflationary side. Personally, I think we're going to see both. I always, since the beginning of this century, when we went into gold, I always believed that eventually it will end in hyperinflation. But hyperinflation is not. It's not going to be inflation in every area, because there'll be inflation in obviously because of debasement of currencies and in commodities and services, etc., and food. But it won't. But it will be a deflation in a lot of the bubble assets. So how do you see this? I mean, you've listened to both sides more than any of us because of your talks. What is your own judgment of this, Grant?
Well, what I've decided, and the extraordinary thing is the quality of thought on both sides of the debate is outstanding. Lacy Hunt and Dave Rosenberg, I hold up as the two kind of main pillars of the deflationary mindset community, and they're extraordinary thinkers, both of them, and the case they make is incredibly persuasive. On the other side of the equation, you can lump just about everybody else, and I guess the most remarkable about turn for me was Russell Napier, who has been a staunch deflationist for 20 odd years, and he is now not just thinking that deflation's coming to an end, but is in the inflation camp and thinks we'll see significant inflation this year. I recently spoke to another friend, Dylan Grice, who put it another way. He said, the bull market in duration is over, which I think is a great way to put it. But what all those conversations have really hammered home to me is it's about timing. Because you're right, Egon, I think we get both. And do we get one last deflationary shock? It's highly possible that we do. So it really comes down to an individual investor and what are you trying to manage? What's the time horizon you're trying to manage here? Because if you have, I think, anything past a couple of years is the time horizon you're looking to invest along, then I think you have to be concerned about inflation. Because if we do get that deflationary shock, we've already seen what they're going to do. They will go to lengths that will make what they've done so far seem trivial. So we can expect a monetary blitz, we can expect a fiscal blitz, we can expect them to cap yield curves, we can expect them to do all kinds of things. They will do anything at this point to stop that deflationary pulse taking hold. So while you may get a deflationary outcome in the short term, I personally have come down on the side that long-term inflation is the thing I have to be most concerned about. And I've talked about this before in other conversations, but the big thing for investors is to understand that if you've had a portfolio that has been set up to benefit from a deflationary tailwind, that portfolio has performed very well for 40 years. It will perform terribly if we have an inflationary environment for obvious reasons. And so this inflection point that we seem to be at or close to suggests that if we do shift from deflation to inflation, then that 180-degree shift does the same in all kinds of areas. It changes the focus on away from financial assets and towards real assets. It changes the focus from, it ends that duration bull market, as Dylan has talked about. It means you want to be in value, not growth. It means you want to have active managers, not passive managers. And it means that your portfolio is potentially set up the exact opposite to how it needs to be set up to manage the conditions going forward. So I think everybody has to take part in this debate and at least listen to both sides, think it through for yourself, understand what does it mean for my portfolio if the inflationists are right, and then decide if you think they're right. If you think they're right, then you have work to do on your portfolio. If you think they're right but not yet, then you probably don't have work to do, but you need to start creating a plan for that point in time where you think, okay, now's the time the inflationists are going to be right. And if you think that Lacy and David and the deflationists continue to be right, and they will be right for the foreseeable future, then frankly, you can sit back with your portfolio and you'll probably still do okay. But everybody has to do those calculations now. It's incumbent, I think, on everybody who's investing to take this seriously, because if this inflection point is real, it does change everything.
But do actually investors, I mean, if you talk about the average individual investors, I mean, they only know one thing, markets always go up, because, I mean, that's what we've seen. I mean, I've been through quite a lot of setbacks in the markets, I mean, in my working life. So I went through the 73.4 one, and I saw the company that I worked for in the UK, Dixon's at the time, which was a retail company, consumer electronics, and I had my first options at 135 pence in 72, and in 74 they were 10 pence. Because consumer electronics or consumer durables, they move faster than the market as a whole. The market was down 60-70% in the UK, and we had high inflation, etc. But I've seen collapses, and then of course most of us have. Even Ronni might remember the 87 crash, and I don't know if you were too young then, Ronni, but maybe not. But nevertheless, and then we have had the 2000 and the 2008, 9, etc. So we all been through a few crashes, but overall, now investors, I mean, they're totally immune to any setback. And you even take the one last year, massive setback, and it came back within a month due to stimulus, of course. And all of this, the whole of this period has been due to more money being printed and flooded into the system. So it's been extremely easy for investors just to stay fully invested. And I don't know any stock market investor, certainly not any individual, whoever would think about getting out of the market, whatever happened, until it's too late. And at some point, my view is that we are looking at now fundamentally and technically, and we're looking at a picture which is an era and a cycle which is coming to an end. And this when that comes, the fall is going to be dramatic in real terms, in my view. The fall measured in real terms against gold is going to be, I think, up to 90%, which it was in the 1930s, 29 to 32. What do you see, Ronni?
Well, I could quote from an interview that we had in our new In Gold We Trust report from FOMC, and he's quoting another, which is, perhaps you've heard of those bloggers on the internet. It's a bit mysterious, but I think it's, even for people who know quite a lot about the gold market, it's super interesting, and it's really just jumping into the rabbit hole. And he once said another, so he was the very first one to put on those comments on the then very, very new internet. He said, gold will be repriced once, and this will be more than enough. And I think this confirms very much my view, and this is what I'm telling people asking me, well, gold looks technically weak now. Do you think it can go down to 1750 or whatever? I say, honestly, I don't really care too much, because at some point it will be revalued, and then we won't talk about $20 up or down. It will be significantly higher. So this is the long-term view that I'm having. At some point,
can I just add
Sure.
Ronni, can I add for the audience? So yeah, for it's an interesting name. It was another started it, and then the friend of another started it, and then was a friend of another. So they became for FOA. But basically, yes, so they are talking about a total reset once and for all. But that's not a structured reset. That is an unstructured reset, isn't it? Or actually, when something happens in the system, rather than any government or any organ, because they talk about free gold that where no one has control over gold. Paper gold basically will disappear in that scenario. Isn't that right?
Exactly. This would be the end of the fractional reserve gold system, and I don't think it has to be complete chaos. Actually, if you would have told somebody in 1971 that gold will go from $30 up to $850, and that we would see massive stagflation in the US, and that the US would have to issue debt denominated in Swiss francs and in Deutschmark, everybody would have said, well, this is going to be the end of the whole system as we know it. So I think we shouldn't underestimate those transition phases, and I hopefully, this grand liquidation that we will see at some point doesn't end up in a big chaos. And I think, from studying monetary history, that in these transition periods, gold always played a major role, and it's no coincidence that the most important countries still hold the largest chunk of their monetary reserves in this weird golden metal that for some reason I think Bernanke said that it's just a tradition. I think they really disagree, and I think that in such a transition phase, I think that gold will be remonetized, as it's always been like that. So that's basically the thesis of FOA, that we, to most parts, agree. It is, as I've said, diving into this topic. It's very, very interesting. Lots of stuff that you can learn, even as a diehard gold bug. And I think the historic framework that he operates on is 100% true.
Yeah. Okay. So just coming back to the original question. So where I think you are also, based on your report, also you are basically in the inflation camp as regards what's going to happen in the next few years, Ronni, aren't you?
Yes. The leitmotif of this year's report was the monetary climate change, and it's I think it's a bit of a provocative title, but we said, well, everybody is talking about sustainability and ESG and climate change, but nobody really talks about the sustainability of our monetary system and what inflationism does to our economies, to our capital structure, to our society. And in the report we said, well, there's a couple of reasons why we're now moving from let's say structurally stronger deflationary or disinflationary period to a period where this pendulum is really swinging into the inflation, on the inflation side. And what are the reasons? First of all, we're seeing lots of unintended consequences of ESG. I think that the whole ESG environmentalism is going to drive inflationary effects. We saw that with Exxon shareholders. We saw it with Royal Dutch. Of course, there is tremendous pressure on those oil companies, and I think that people forget that oil demand is still rising. People tend to forget that national oil companies don't really care about those environmentalists. So we are actually substituting something that is relatively cheap and abundant with something that is at least temporarily far more expensive form of energy. So I think we're really seeing from the ESG side lots of pressure on the inflationary side. Then we're seeing this move that I talked about before, this move from monetary dominance to fiscal dominance. We're seeing that globalization is to some degree retreating. We're seeing that velocity of money has stabilized and now starts to rise. We're seeing that Asian countries are now starting to export inflation and not deflation anymore. We're seeing that
so we're freezing here for a while.
That demographics are questionary side, but I think what's really going to happen soon is that we are seeing that there's a shortage of labor in certain industry, and we will see rising minimum wages. We are seeing rising unit labor costs. So I think that wage inflation will really become the next big topic. And if you talk to people from the building industry, if you talk to people from various industrial sectors, everybody says, well, it's a disaster. We're seeing inflation all over. So therefore, I think, although I read Dave Rosenberg really every day, and I think he's one of the greatest out there, I still believe that inflation will be the major topic of the next couple of years, and
No, I agree with you, Ronnie. Although what I see everywhere here in the UK and in Switzerland, that some of that inflation now is COVID based. Of course, there is a shortage of certain things, and people are taking advantage also in their pricing. A lot of people are repricing, blaming COVID because they can. There are shortages. But come back to stimulus and grant, an area that I'm looking a lot at now, which I think could be potentially very dangerous for the world, and this is the whole repo side. As I said before, I mean, as I look at this current crisis, it really started with the repos back in August, September 2019, when there was something not right in the system, and then it was exacerbated by COVID, with massive injection of liquidity, and now we are seeing almost $1 trillion daily reverse repos. And that's, people think that, there's too much money in the system and there's too much liquidity at the banks. But from what I understand and how I look at this, it's not a question of too much liquidity. It's a question of money market funds, basically, now. And that's quite a big percentage of the total. The 800 billion to $1 trillion, that's about 15% of the total liquidity. And that they're basically afraid of putting their funds with the banks, and therefore they instead giving it to the Fed, and the Fed is paying them less than they would have had otherwise, but they get security for that. Grant, how do you look at that, Mark? Because I mean, that in itself is potentially could lead to some major problems in the system, because obviously the banks will, once the money market funds are taken out of the banks, putting it to the Fed, they lose reserves, they have less lending power, and there's less liquidity, and that can affect the whole of the financial system and asset markets.
Liquidity is what's put markets at all-time highs. Liquidity is what stopped the bank runs back in 2008. Liquidity has been the fuel for this. And so, away from the headlines, there's a guy called Michael Howell who runs a firm called Cross Border Capital, and they monitor liquidity flows. And they put out some great work on this, and they've posted a couple of charts recently that show that cross-border liquidity is declining quite quickly now. And the problem here is that the thing that retail investors see in the headlines. They see markets going up. They see stock prices at all-time highs. They see people make money in crypto. They see all these wonderful things happening. That gets fed by the TV networks, who are paid by advertisers who want eyeballs. And what brings eyeballs to CNBC? Stories about how you can make money. You notice that once markets have major corrections, at the time that there's significant volatility, viewing figures go up. But once the losses happen, the viewership drops significantly because people have lost money. They're sick and tired of markets. They don't want to invest ever again. So what people need to understand is, away from those headlines about markets at all-time highs, what the professionals see, what the professionals have access to, is information that retail investors don't have. And that information, reverse repos being one of them, suggests that there are warning signs flashing about liquidity. And if liquidity dissipates in this market, then the markets will go lower, make no bones about it. If there isn't ample liquidity, then markets are going to struggle. So you're right. What we're seeing is a sign that liquidity is contracting. There are plenty of other signs that you, as I say, you won't really see unless you really dig into the plumbing, but they're quite consistent across the board. And so that's another signal that it's a time to be cautious. It's a time to understand that, the free market, free money, the wild markets crescendoing day after day after day, it doesn't go on forever. And you only have to understand a little bit of history to see that. So I think reverse repo is a flashing warning sign that something's not right with the plumbing of the system. And when something's not right with the plumbing of the system, generally that's a problem for the system overall. Lehman was a plumbing problem, really. That's what took Lehman under. So people need to be aware of that. And again, look, it's about understanding what's going on. It's about understanding what you're invested in, why you're invested in it, and what your long-term plan is. If you understand all those things and you constantly recheck them all, you'll be okay, because you will at least know why you're in something. But being in the market because it's going up is a very, very dangerous place to be at turning points like this. So that's the thing I would caution people against, is that if you're just in the markets because they're going up every day, you need to do a little bit more work than that and understand why they're going up. Understand that the reason they're going up is starting to kind of recede in the background. And it may be time for you to say, you know what, I'm going to sit these next few months out. And if the markets go up a bit further, okay, and liquidity comes back, that gives me a reason to go back into the markets. But just markets going up every day is not, at this point in a cycle, a good enough reason to be in them, in my view.
That's extremely good and important advice, of course, Grant. But as I said before, the dilemma is that people have now been conditioned to markets always going up. So, for the majority, certainly of individual investors, but also of institutional type investors, they know nothing else. And I think the reaction, to the next fall, when that comes, it'll be the same as before. It'll always come back. We'll wait. The central banks will come in, etc. And then at some point, as we know, when the bear market starts, and as I said, I've seen enough of them, and the one in 73.4 was one of the biggest ones. But all of those have been short bear markets. We've never seen, or any of us in our lifetime, a bear market like the 29 top, and then the fact that it took the Dow 25 years to come back to where it was in 1929. None of us have seen that. Now, as I read the world, the bubble now is greater than ever in history. And therefore, I don't see any reason why this coming decline, this secular decline in markets and the world economy that I expect, because it's global now. It's never been global before, never. It's been in individual countries or regions, but not global. And this time it's global. And therefore, I think the risk is greater than ever. And therefore, your warning to investors is absolutely right. But I mean, I would be a lot stronger than that, because I think investing is all about risk. But people don't understand that today, because there hasn't been any risk for a long time, because everything just goes up and up, and it's different today. It's never going to go down again, markets. But that ain't going to be the case.
That's very true. But at the same time, I think you and I, not so much Ronnie, because he's much younger and much more handsome than the two of us. But we have to caution against, because it sounds like you and I are constantly saying, "Oh, get out of markets, get out of markets, get out of markets," and that's really not the case. It's an important distinction to make, that understanding why you're invested in markets and understanding when the risks dictate that you take your risk levels down, you have less in the markets. You don't have to, it doesn't have to be, it's not an on-off switch. You don't have to be 100% in the markets or 100% in cash. It doesn't work that way.
Yeah.
But it's important for people to understand that there are times to have a bigger allocation to risk assets, and there are times to have a bigger allocation to hedges and safety and liquidity and cash and all those things that allow you to take advantage of declines. And right now, given what we've talked about already, given the extended valuations, given everything that's going on around us, it's just incumbent upon investors to assess the risk that their own portfolio faces if they happen to be caught 100% invested in markets and they're wrong. And, there are times when that's not the worst thing that could happen to you. If markets aren't extended, they're just a little bit frothy and you're 100% invested and you're wrong, okay, you may lose 10%, which is not great ever. But right now, given how fragile everything is, if you're 100% invested and you're wrong, you could lose 50%, you could lose 60, 70, 80%. And that's happened in the past. And it will happen again, whether it's this week, next year, we don't know. But it's about assessing the increased chance of that happening and what that would do to your portfolio. And those big drawdowns are the one thing that you have to avoid as an investor at all costs.
Yeah, because the 50%.
But I think, Grant,
Go ahead, Ronnie.
I think that people, there's analysts doing nothing else than just analyzing the stance of the FOMC voting members, if they are rather dovish or rather hawkish. But I think the most important voting member is the S&P. So I think everybody kind of knows that once the S&P goes down 5 or 10%, that the Fed will come to the rescue. And I think that's something that Powell said in 2018. And I remember, Grant, when you wrote a piece once where you said, well, Powell, he's different. He's he's not an economist. He's not an academic. He's coming from the real life. But I think he isn't really different, and he has shown that. And in 2018, he said, we would like to smooth out the wild swings of past economic cycles by fine-tuning monetary policy. So I think that's, it should be crystal clear now that the Fed is being slaves to the bubbles that they blow, and I've really got no idea if there's any out from their point of view. But I think what are the alternatives? In an environment where inflation really is becoming a topic, do you really want to be overweight cash? I've got a really, really hard time, but what I'm criticizing always is the fact that people that can't really stand or deal with the volatility of the stock market, for example, they're pushed into riskier asset classes, and this is something for the millennials. It's they are always being criticized for what they're doing with their Robinhood accounts, but I think it's something positive that younger people start investing into the equity markets, because they, at least in theory, they should have a very long time horizon and a low time preference. So it's not all negative what's going on. However, I think
for sure.
What we really see now, and I can feel that, is this what Mises would have described as a crack up boom. We're seeing it in real estate all over. I just saw recently that an Italian artist sold an invisible piece of art for $15,000. So we're already seeing this craziness of the environment that we were pushed into. And
but why not,
therefore,
Ronnie? They're selling invisible money for $65,000. All that's gone down to $32,000 now. So why not sell investable art?
but Egon, what I wanted to ask you, not if you would like to buy my invisible piece of art that I would sell you for 100,000, but
Yes.
but what do you see in regards to gold at the moment coming from your clients? Because over here we're seeing lots of interest from, I would say, high net worth individuals, mostly people that are already invested. A big topic is geographical diversification. That's more of a topic than in the past. But I don't see new demand or new interest coming in. Do you have a different view, or what's your take on the most recent developments in the gold market?
No, Ronnie, we've been in the gold market for 20 years now, and we went into it, as you know, just because we saw the risk, not because we're gold bugs and wanted to make money on gold. We just saw the risk in the world, and we saw that the likelihood of money printing and debasement of currencies was going to continue and accelerate. And that's why we were fortunate in timing it at basically the bottom of the cycle at $300. So since then, I haven't changed my mind, and we as a company haven't changed our mind, and I'm not going to change my mind on the economy and what's going to happen, and on the insurance or hedge or wealth preservation aspect of gold that I think is absolutely essential. And whether people have 10% or 50% or more, that's up to each individual. We never tell them what they should have. People should have what they think is right for them. But then every time they don't hold gold, they should say, so what do I do with the rest of the money? Do I think that the stock market is good risk to invest in now? Do I think the bond market is right? Do I think cash in a fragile banking system is right? So you always have to look at what you do with the alternatives, not just look at, how much gold should I have? It should, what risk do I want to take with the rest of my money? And with the stock market that has gone up exponentially for years now. So therefore, it's very easy for us. I'm a long-term investor and risk analyzer, if you want. And therefore, my views and our views as a company are not going to change. Now, that doesn't answer your question, but what I'm saying is that we have the clients that we enjoy having. These are the people who think like us. They don't trade. They don't take money out of when gold goes down. They don't sell. They're actually, as we are, long-term wealth preservationists, and they're worried about the risk, and they want to keep their gold outside the banking system. Now, we cater for the bigger investors just because we decided that suits us. So in our Zurich vault or Singapore, we have $400,000 as minimum, but in our mountain vault, we have $5 million. So we are, but as regards the general flow of gold investment now, it's very slow. You're absolutely right. That's across the board. That's across the world. We know that. We talk to others. We talk to refiners, etc. So people last year, as you know, starting with February, March last year, there was massive gold buying, and it continued for a big part of the year. This year has been a lot slower, but as you mentioned, we deal also with a lot of high net worth individuals. So we see people at that level, which is not lots of little investors, but fewer bigger investors. We see that flow continue, and we see quite a lot of people, very wealthy people, moving gold from the financial system into the private vaulting side, which we are experts on and which we assist them with. And I think so that trend it's quite interesting that there are a lot of people. Most of the gold in the world held by investors is still, I'm talking about physical gold, is still held within the banking system. We have to remember that there are lots of private vaults around the world, but still the big banks hold most of the gold. But slowly but surely, we are seeing more and more people moving out of that system because they are worried about what's happening. That's really what we see now. For the average investor, we need to see again price movement, because now it's not, most people like buying when it moves. As we know, I measure, one of the charts I show all the time is the gold price against the U.S. money supply, and it's now at the level where it was in 1970 against U.S. money supply. It's at the same level as 1970 when gold was $35, or 2000 when gold was $300. So we are gold is as cheap now against the money issued in the U.S. or in the world as it was at those times. So people should buy gold low, but they don't. Some do, but most people like to buy when it moves. And we are going to see the next move, I think. Coming back to gold, since we led us into that, I see the correction that we've had since August 2020. I think is finished, and we had another correction, a little bit correction in the last few weeks. I think that's finished too. So I think the uptrend is there, and we're. The level we will reach, I don't like forecasting a price. I think it's only a function of how much will currencies be debased, as we all know, Ronnie. And that price you can add as many zeros as you want, depending on how much currencies will go down. So yeah, gold. To summarize, gold is right now not in high demand, but I think that will change in the next few months, certainly. Grant, what do you see?
I've always looked at this very differently, and what you said there speaks to that. You said right now things are very quiet, and that there's a lot of information in that simple statement, because things are really quiet right now because people don't feel a need to own gold because the stock markets are going up to new highs every day, and this fixation upon the gold price is something I kind of campaign against for years, because it's a spurious way to think about it. People who are buying gold and expecting it to go up in price are missing the point, and people who sell their gold because it goes down in price are missing the point. The fact that it's quiet right now speaks that people don't necessarily have any real fear, and the markets are suggesting that they're right because they're making new high after new high. Behind the scenes, a couple of things happen. As we've talked about, liquidity is slowly being drained from the markets. And on the gold side, more high net worth individuals, more financially savvy people are moving their gold out of the banking system and into independent private vaults. And there's so much information there. Yes, the big move in gold comes when everybody's trying to scramble to buy gold, and the price will go up at that point. But this is about purchasing power. This is about protecting your purchasing power. And people really need to try and think of it that way rather than fixate on the gold price. I keep using this example, but it's such a perfect example. People who don't understand it will criticize gold in the teeth of 2008 and say, well, when Lehman went under, gold went down in price. And it did. And people will say, well, the gold price was supposed to go up. I mean, here's the system collapsing and gold didn't go up. The reality is two things happened. One, people who owned gold sold it to raise cash because they had margin calls left and right as the financial system's imploding. So gold did what it was supposed to do there. It was a store of liquidity for them when they needed it. The price went down. Yes, the gold price went down maybe 10%, but the stock market went down 60%. So your purchasing power in units of the S&P for 1 unit of gold went up dramatically at that point. So even though the gold price went down, you could have, had you decided that, okay, my gold has done what it's supposed to do, it's insulated me from the financial crisis. I think the market is bottoming in March 2009. I will exchange, not sell my gold, I will exchange my gold for the S&P 500. hey presto, you could buy almost 5 times as much S&P 500 as you could have done on September the 14th, 2008. Forget the price of gold. It doesn't matter what the price of gold was. It matters that it almost quintupled your purchasing power in units of the S&P. And if you can find a way to think about gold in those terms, then you understand the opportunities it affords you in periods of great stress, or the opportunities it affords you when certain asset classes are, for reasons of liquidity, for reasons of anything, are suddenly chopped in half. Gold gives you the ability to step into those assets at discount prices, even if the gold price has also fallen marginally. It's not about the price, it's about the purchasing power and about what gold does to a portfolio as a liquidity reserve.
Yeah, no, I totally agree. And of course, that's since none of us see any change in the debasement of currencies and in the current risk in the system. That's why I said I will not change my mind until something has happened to this system, whether that is just unlimited money printing or whether that's default of the whole part of the financial system or whatever. So therefore, from that point of view, it's quite easy, the decision. And I'm showing a annual chart of gold since 2000. Remember, if you look at the annual change in gold since 2000, it's gone up. It's gone up 20 or 19 years and down only 3 years. It's only down in 13, 14, and 15, sideways in 1 year, 16, 17. So, if you look at an annual chart of gold, I mean, it shows so clearly the bear market in the currencies and the destruction of paper money, and therefore gold reflecting the other side of that, going up dramatically. I mean, it's a chart going virtually straight up with a correction for 3 years. So that's, as you say, we don't worry about the price either. We never worry about the short. I never worried about any correction in gold because I know that central banks and I know the system will always support us by this destroying the currencies. And this is what you've written a lot about also, Ronnie, in your report.
Yeah, well, so many things to say, and every year we think what to write this year, and then we end up writing 350 pages and still think, well, there's still so much to cover. But I think many people were a bit. They were a bit sad about the developments in gold in the second half of the year, and I always said trust comes from repeatedly fulfilling expectations. And I think that gold exactly did what it's supposed to do in a year like 2020. It reacted very quickly to rising inflation concerns. It acted as an equity hedge. It acted as a recession hedge. So, gold was up in dollar terms, it was up 25%. In euro terms, it was up 15%. So it did a tremendous job, I would say. Now, last year, of course, then we saw a slightly stronger US dollar, and we saw that that yields were going up. But I think there's only one reason why I would become concerned about my gold position, and this would be if real yields would rise significantly. So real yields at 4 or 5% plus, then you can probably lower your gold position significantly. I just don't see it. I just, the debt piles, the debt mountains were already pretty high before COVID. Now they're significantly higher. So this means that there won't be positive real rates over the next couple of years, probably over the next couple of decades. So I think returning to the gold market, it's pretty interesting what's going on at the moment. First of all, if we remember last August, when gold made new all-time highs, everybody was talking about gold. Now we're trading at 1800 and nobody cares about gold. Goldman Sachs was recommending shorting gold. UBS said gold will see further downside. So I think we're we're basically hovering below the all-time highs, and the fact that the sentiment is so negative, that's a pretty positive sign. Then we're seeing, for example, some pension funds going in. There was the DSM fund from the Netherlands. It was pretty interesting to read their statement. They say they are reducing the fund's exposure to government bonds by 10 percentage points because of the very negative expected return on the asset class. So, you know, they're selling bonds and they're buying commodities, they're buying gold. I think yeah, we will see many more of those statements. Then if you have a look at COMEX gold deliveries, they continue to be extremely strong. In some months, they're 3 or 4 times higher than the average. So that tells me that people now really want to hold physical gold and not paper contracts. Yeah. Then we're also seeing lots of demand from the central banks. The Hungarians, you know, they had the highest hyperinflation in the history. They were buying significant amounts of gold. The Polish, I think the Russians just recently said that they will buy 4 billion.
4 billion, yeah.
And that they got rid of all their dollar reserves. So there's quite a lot of interesting things going on. On the other hand, nobody's talking about gold. So that's a pretty good setup, I would say. And by the way, I've got the numbers here, Egon. You said that you did found your company 20 years ago. Gold was up 17 out of the past 20 years. So that's a pretty impressive win rate of 85%. So that was a pretty good move. Congratulations.
Yeah, Ronnie, I think the other important point to make there is when you're talking about the Goldman Sachs and the UBS of the world saying gold is going to go lower and you should short gold, that's a short-term tactical call. Yeah. When you look at a pension fund swapping 10% of their government bonds and moving some of that into gold, that's a very long-term call. So the people with an eye on the future are looking at the investment landscape and saying, you know, the bond market, to Dylan Grice's point, the duration bull is over. What do I need to own? And gold for the longer term for a pension fund makes an awful lot of sense. And that pension fund won't be doing this in isolation. There will be other pension funds coming to these similar conclusions because they have to. They have to look out 10, 15, 20 years and allocate accordingly. Whereas the Goldman Sachs and UBS of the world, they have to look out 10, 15 minutes and allocate accordingly for their clients. So again, there's so much information in not just those calls, but who's making them. If you understand central banks have a much longer term view, pension funds have a much longer term view, they are buying. Ultra high net worth individuals are buying. They have a long-term view to protect their wealth. Trading houses, investment banks, sell side analysts are advising, you know, sell in the short term. So understand which of those categories you fall into. Are you looking to capitalize on short-term movements in the gold price? In which case, listen to UBS, listen to Goldman Sachs and roll the dice. If you are using gold as a portfolio allocation or a liquidity reserve, then you are far more aligned with the pension funds of this world who are taking a longer-term view, and you should be taking your clues from what they're doing.
Just a brief comment on Goldman Sachs. I mean, I know from experience that they never do what they say. So whatever they tell and advise clients, their trading side will often do the opposite. So it's not a reliable indicator very often what Goldman Sachs says. But you know, pension funds, I think, and I've been saying for a while, I think that will be one of the major groups of investors into gold for the simple reason that if we are right, the three of us, that we are leaning to the inflationary side of the world economy, and therefore pension funds and institutions would be obliged to inflation protect their assets by holding some gold. And we saw the first one was the police and fire pension fund in Ohio, and then saw the Dutch one, we saw the Swiss one, the cantonal one also now recently putting it into physical outside the banking system, which is interesting, not even into bank, not into ETFs. So I think that trend will accelerate in coming years. Obviously, pension funds take a long time to make a decision, but it's quite significant that this has happened now. And I think there will be a very strong trend going forward. And of course, as we know, there won't be enough gold for pension funds having any major allocation to gold, and the only way they can have a bigger allocation is just by a higher price, not because there won't be any more gold produced, and there will be very few sellers of gold. Gentlemen, this has been a fantastic conversation. Is there anybody that wants to add something before I sum up here? Any questions or anything that you'd like to add that we have missed?
I'm happy to leave it to you to sum up. I think it's been a really hugely enjoyable conversation.
Yeah, we can still talk about football, and we said previously, Egon is very well hedged because he can cheer for Switzerland, England, Sweden, and almost Italy because he's very close to the border. So he can only win.
There's only one team I'll be cheering for, gentlemen.
And I only got Austria.
I only got one team left, so it will be England, of course. Yeah. Anyway. Thank you so much. It's been absolutely fantastic and fascinating, and we've covered a wide area of topics, and I think from my point of view, what investors and people who watch this should really think about is not a question like where will gold be at the end of the year, where will silver be, where will the stock market be. Excuse me for saying that, they're totally useless questions. It doesn't matter where any market will be at any point in time, in the calendar. It just doesn't matter. We just talked about 20-year gold here. That's what matters. That's how Warren Buffett made his money. That's, for most people, long-term investment is what it's all about. And the second thing is, which we all pointed out, Grant, Ronnie, myself, is risk, managing risk. And risk is going to increase dramatically in the next few years. So therefore, you as investors, you have to be so careful. Ronnie, some final words?
No. I think it's been a really interesting discussion covering so many different topics. So thank you very much for the invitation. And I really enjoy being an advisor to Matterhorn. And I wish you gentlemen and all people watching this a fantastic summer, because I think it's gonna be a quite interesting fall and winter ahead.
Yeah. Thank you, Ronnie. Thank you very much. Grant?
Thank you.
Yeah, look, gents, it's always so fun to get together and have these conversations, and I've enjoyed this one every bit as much as all the others we've had, both in these webinars and in private. They're always, as you can hear, we've closed this at exactly the right time. Now there's some sort of drill going on next door. I have no idea. Someone's putting up a huge mirror or something, I presume. But again, thanks, Egon, for inviting me to be a part of this. It's hugely helpful to kick ideas around with you guys, and hopefully the audience have taken away from this some useful things to think about, because I think, as Ronnie points out, there's going to be some bumps in the road ahead, and having the right framework through which to think about them is going to help tremendously.
Yeah, absolutely. I think we've all taken away a lot from this conversation, and of course we will have many more. We're all young people, as Grant pointed out. Ronnie happens to be, unfortunately, the youngest. We can't help that, but I mean, but we're all young in spirit, Grant and I, and Grant is much younger than I am in spirit. So, but anyway, it was great to talk to you all, and thank you so much. And have a nice summer, and we'll be back in the autumn sometime. Thanks so much for listening and viewing. Bye bye.